All right. Good morning, good morning, good morning. It is Wednesday, December 20th, and I'm thrilled that we are doing our crystal ball for 2024, which is incredibly exciting. Those of you who are astute will note that there's a giant head behind me here today. That is because Ron Butler, whose face it is, may join us, may not join us. We are not sure. If he does join us, I'll remove his giant face. If not, as punishment, this is my background for today. All right, but regardless, we have two so first off, a couple of just minor things. All of our sessions that are recorded are public. Anything you say will be put out on public forums. Be advised, there will be close to 100 to 120 people here. We're already at 80, so be advised, this is going to go out to a whole lot of people. Second thing, we are wrapping up our charity event this week on Friday. We are $2,000 away from our goal of $25,000 for breast cancer. That's awesome, guys. $23,000. I'm incredibly grateful to all of you. $2,000 more. Please, please, please push your friends, push whoever it is. Let's hit that limit. Let's make ourselves proud. I think we can all be really proud of what we've actually achieved over the past 2 weeks. I'm exceptionally proud of all of you. I'm grateful to all of you. Please, let's keep that going. Now, on to where we are. As ever, those of you know, we start at 10:05, so I still have 2 more minutes for blurbs, and those 2 minutes are going to be introducing our guests. If Ron comes in, I'll make an introduction for him. Ron, are you here by chance? There's a lot of people here. I don't think you are. Okay, fine. The 2 guests that we have to discuss this are the same as last year, and honestly, it was one of our highest rated events, and for good reason. Dan and Jordan are people who anyone who is in our industry know as a matter of course. There is no way that any of you who are in pre-con have not come across Jordan's work, and any of you who are looking at prognoses of where we are on a month-to-month basis have not seen Dan's. They both stand on their own merits. I really don't need to give them an introduction, but hell, as it's not yet 10:05 and I have that minute, I'm going to. Jordan runs is part of iRise and runs the pre-condo team, which I think is the biggest pre-condo website now in Canada. If second, but I'm going to say the first because what the hell, he's not going to correct me, and it makes him look even better. And Dan, of course, works for Rare Real Estate as their primary data guy. I'm sure there's a better way of saying it, but is that in his data I find and glean insights that instruct me in how I deal with my clients every day. So without further ado, I'm going to turn this over, and I'm going to start with a simple question, which is maybe we should start with a recap of 2023 and just ask where we are presently. And then I'm going to turn to both of you and then ask where are we going in 2024, which is the big question. And then from there, we'll get additional questions. But Dan, maybe we can start with you. Maybe you could tell us about what 2023 was and where we're going in 2024. And then I'll turn that same question to Jordan. And
Sure, yeah,
I've given you administrative access, so please feel free to share your screen if you want.
awesome. Yeah, I think from I will put some charts up maybe for subsequent questions. But 2023, quite simply was it was a period of volatility that you could see taking shape from 2022 and 2021. So 2021, obviously we saw the big run up. 2022, we saw the peak in Q1. And then we saw the biggest drop in house prices in Canadian history in 2022. Q1 of 2023, I'd actually be curious to see what we said at the end of last year, but we had the strongest spring market in Canadian history this year as well. And so that was the highest price growth that you've seen in a 5-month period ever in Canadian history. And so, I mean, in the past 2 years, you've seen basically a 20% decrease in price and a 10% increase in price. And then for the remainder of the year, the market kind of just slowly flattened. The air just kind of got let out of the tires. And so the question is, why did we see such a strong spring market? And could we see a strong spring market next year? My thoughts are, you can see a lot of this just by looking at the bond yield curve. So when you're examining interest rates, that buyers are using in Canada. The Bank of Canada kind of lost their ability to control the demand curve as soon as fixed rates were the mortgage of choice for purchasers, and that took place towards the end of 2022. So once your fixed rates eclipsed variable on just making purely based on the assumption that borrowers are going to take the cheapest rate, which isn't always the case, but it does seem to be sort of the case. So towards the end of last year, you had 75% of borrowers going into fixed rate products rather than variable rate products. And that basically means that the bond yield curve, the Government of Canada 5-year bond yield, which sort of is loosely the pricing mechanism for your 5-year mortgages. They're usually priced at GOC plus 2%, give or take. So the 5-year bond yield plus 2% risk premium. That determines your demand curve in that situation. And so now all of a sudden, the Bank of Canada really only has the ability to impact the supply side directly through policy, and they can impact the demand side indirectly through the language that they choose in their statements that can kind of bring down the yield curve. So that was just sort of context. Q1 of this year, we saw the Canada 5-year bond yield drop heavily twice into February and April. And those were when you saw the market giving out these 4.5% interest rates on the fixed. And when you think about somebody who's taking a fixed interest rate, and in a market where interest rates are volatile, if you get a 4.5 fixed rate hold and you have 120 days to burn through that rate hold, and then after that 120-day period, you're seeing rates at 5.5 is what they were at, probably closer to 6%. You have an extreme sense of urgency to use that rate hold. And so you had a lot of urgency in the market in one of 2023. And I think that's really why you had a lot of people with increased borrowing power or buying power from lower rates. They had a sense of urgency to use those rates quickly. The last piece that I'll add is, and you could guess pretty easily just based on whether or not the Canada 5-year bond yield heads in the direction, whether or not we will see them really strong. The only caveat is I think we've burned through a lot of the demand. Like I agree with the thesis that there are buyers sitting on the sidelines waiting to buy, but that is an exhaustive or exhaustible buyer pool. And so the other question is, if people think that the variable rate is going to come down, then the market might not depend as heavily on the fixed rate as it in Q1 of next year as it did in Q1 of this year. And so, I mean, really, from my perspective, the whole market, you could really just see it following what was happening on the Canada 5-year bond yield throughout this year. Beyond that, I think, and Jordan's probably going to touch on this a little bit, but I mean, a lot of the air has been let out of the tires in the pre-con space, and so I think you are seeing a lack of demand for the future sales pipeline, and obviously we saw immigration numbers come out yesterday. I mean, the supply and demand imbalance in the fullness of time is something to be paying a lot of attention to. It's just, when does that outweigh the impact of constrictive monetary policy? So I hope that answers your question, Mark.
It absolutely does. That was a fulsome response. Jordan, over to you.
Yeah, so I mean, yeah, the air's been let out of the tires. You could say that. So in the pre-con industry, we've got 12,000 sales across the GTA this year. 10-year average should put us at about 21. Previous 2 years would put us over 25. Now, one interesting thing of note on that is, when you're talking about a condo building rather than a subdivision, you're required to achieve about 70% sales, pre-sales, before you can actually get a construction loan to break ground. Now, there are a few developers in the city of Toronto that have the financial capabilities to go ahead with construction without a construction loan to essentially self-finance, but that pool of developers is very small. And so most of them do rely on getting to 70% pre-sold. If you look at the 20 odd launches across the GTA that we've had since September of this year, you'll see that only two of them, 2 out of 20, so 10%, have achieved 70% pre-sales and are in a position to break ground. This sort of brings us back to the pre-2016 era, when pre-construction didn't sell over the span of a weekend with 2,000 worksheets and 400 units. And so now developers have this slow burn of sales where it takes a long time. Now, there are a number of reasons for it. Obviously, the biggest one is sentiment and rate increase. The other portion of it is just simply pre-construction prices don't make any fucking sense right now. So you're talking about, if you look at a condo launching in Moss Park, not exactly the most desirable location in Toronto, unless you like starting your mornings with coffee and human suffering. Those condos are going to launch at $1,600 a square foot because of the cost of construction inflation, the land cost inflation, et cetera. Now, this year we started to see those things correct, right? So forming, for example, we've seen come down 20% already. That's a big part of a construction budget. And we've seen land values in core Toronto fall by 20-25%. But the land cost of the overall project revenue is only 10 to 30%, and the construction cost 30 to 40. So again, what we're talking about is we're talking about a $1,600 a square foot launch coming down to $1,500 a square foot. But resale is still sitting at 12 in that pocket, right? So buyers have to be okay with high rates, terrible sentiment, and they have to be okay with paying a 20% premium, 25% premium to buy that pre-construction condo and hope that the thing's going to be worth more than they paid, in 5 years when the thing closes. So of course, pre-construction sales are incredibly slow right now, and buyers and end users are still buying pre-construction. But obviously, pre-construction in Toronto is predicated on the investor. The investors buy 75+% of pre-construction condos, particularly when you're talking about high rise, high density in the core, that type of product, or on the subway line, that sort of thing. Boutique is a little bit different. So to Dan's point, yeah, the supply demand is a big question, right? We saw 14,000 units not launch this year that would have otherwise launched if the market could support the sales volume. So developers are just, if they can afford to hold off, they are holding off. And that means that supply that would have launched this year and started construction next year and been ready in 5 years is now not going to be ready. It's now pushed further in the pipeline. So that's kind of where we are today.
Amazing. I'm going to speak on behalf of the lawyers of this channel. Being a lawyer these days sucks. I can't remember the last time I've had to say that, but it really does. 2, 3 discussions a day now about breaches, about not being able to complete. Jordan, at what point does this not become the buyer's problems? At what point does non-completion of existing product become the builder's problem?
Honestly, I'm not sure that it entirely does. I saw one building, for example, that had 30% lingering inventory and a couple percent default, right? So not a ton of default, but maybe 20 units in total. And they had about 200 units left over out of 800 units. And all they did was they took out an inventory loan and leased out those units on 2-year terms. So I think you're going to see a lot of that, right? Developers, if you fail to close on your contract, developers will keep your deposits, potentially sue you for damages in the event of their resale value being lower than the price minus 20%. But I think that's unlikely. So more likely, I think, is that they take out inventory loans and lease out batches of units until the market recovers and they want to resell those into the resale market.
Sorry, go ahead, Mark.
No, please, Dad.
I was going to say the developers could care less, really. I mean, you and I discussed this maybe a year and a half ago when we saw this trend coming, and I've been doing some research, a lot of research on it with Ben Rabideau for some financial institutions who want to see where the potential problems in the pipeline are and what lenders are exposed to it. And the reality is, and happy to share that with you or anyone on the call. It's not done yet, but happy to send the report out. The developers don't really care because they're getting the unit back at whatever the price they sold it at less the deposit. And so, and then the remainder of the building closes at a value that's higher than that. And so really they're basically getting, usually let's say 20% equity in their own units for free. And then they just, like Jordan said, throw an inventory loan on it and then lease it out. I would expect, to be honest, like if I were to guess a trend that we'll see take place in the next little while, CMHC would probably start touching those on their MLI Select program, batches of units, batches of condo units just to simply accommodate for those for a longer term hold. Because I think absorption is going to be a problem. Like an inventory loan is you hold it and then eventually you sell it. And so a lot of them, they're not renting them out because they don't want to damage the units during that inventory period, and they still want to put them on the market as brand new units. I think that strategy is going to start to shift when they realize that they're basically dealing with the same problem that the market is dealing with right now, which is the decision whether or not they want to lose money fast or they want to lose money slow. And I think a lot of we're already seeing policy being designed to push more and more developers into the purpose-built rental space and to become landlords. And I think that this is an easy way to take existing supply that's super agile. It's a super simple policy stroke to just change CMHC MLI Select to allow blocks of condos. They used to do it. So, and then I think the developers will just end up holding these things at super cheap rates indefinitely.
Can I tell you why I asked the question and where I'm going to
Yeah.
slightly disagree with you guys? First off, I'm going to point out that David Orsino now has Ron Butler's face behind him as well. I would encourage everyone on this channel to adopt this very background because I think it would be very funny to start seeing these all over the place. But on a more poignant note, the reason I'm asking the question is because at our office, we are more and more requesting of the builder not to hold us in default, but to extend VTBs. And we are seeing builders now extending VTBs regularly on their products. That does not speak to someone who's willing to take back these things and does not care. That is speaking to someone who does not want to do that and ultimately is saying, hey, give me the money I can get and let me deal with you putting up a little bit of extra cash and I'm ready to defer for 2 years. So the reason I'm asking this is because I'm seeing something markedly different in practice where default letters are not going out, rather VTB offers are being extended, which is the first time I've seen that in years.
Yeah, so that makes sense to me. I mean, like if you're to go down the chain of economics, like what's going to make the most sense? A VTB does make far more sense for a builder because they are able to self-liquidate their construction loan. So and the construction loan's at a more expensive debt. And so it would make more sense for them to do that than and get that deposit out, start paying off the construction loan and move into a new, like developers want to develop and they want to sell the units. They don't all want to hold them per se. I just think that when faced with the challenge of a completely failed closing, like I would agree. I think that makes the most sense. And it's nice to see that trend taking place. Again,
Yeah.
probably more further indication from my perspective that they don't necessarily, like, I don't think it's going to kill developers. I think the developers that the liquidation issues from failed closings or the inability to do VTBs that we're going to get killed by that, they're already dead. They're literally just like, they're zombies right now walking towards their interest reserve. They're probably negotiating with their lenders. Their sites are probably already failed. I mean, there's, we're seeing bankruptcies all over. Like most of the ones that are the developers that are dead, they're dead already. It's just, when does that appear? When does that show up as a data point because the deal had to close or they missed a loan payment or they failed to pay a contractor or whatever it was, right? So, yeah, I'd be curious to know if you were to sort that, and maybe you're not going to have this discussion another time, not to get too nuanced, but if those are big developers or, small to medium.
No, they're I can tell you straight out, they're usually smaller. They're usually non-condo product. Still, although we're starting to see it in the condo product, and it is not in the larger developers. So just as an FYI, as a data point.
No, I mean, it's interesting because like we've spoken with a lot of ground-based developers, like just because it's just fascinating. And for anybody who's in the market right now that doesn't know about the MLI Select program, like CMHC's program, it's going to change the market, I think, over the next several years. But we've seen ground-based guys, so 8 detached houses or 8 semis, and they can't sell them now, and they're built. It's like, okay, we'll put a basement apartment in each of them. Now you've got 16 units. Put a MLI Select loan on it and hold it as a rental building for 50 on a 50-year AM, right? So that's where a lot of this stuff is starting to head. People are just really looking for any kind of lifeline they can grab onto.
Jordan, did you want to say something about that? If not, then I'll proceed.
No, I was just going to say, like, I think, generally speaking, when you see a 400 unit building closing today, what's still surprising to me is, yeah, you have a ton of distressed assignments, 2 or 3 times the volume you would normally see. You have people selling at losses. You have all this crazy stuff happening right on closing. But generally speaking, across the board on condo product, appraisals are all coming in, and of those 400 units, 360 are closing as planned. It's just the remaining, 10 to 20% that are problematic. And I think if you have 10 units that default, 30 units that panic sell on assignment for a loss, like it's probably the pain in the ass, the return in the ass for taking out an inventory loan on 10 units isn't there. But it's a different story with a block of 100 units.
Yeah, fair enough. That makes sense. We have two really good questions that are going to drive the next part of our discussion. So I'm going to turn to them. I'm going to do the second one first, which Francisco was good enough to mention. I'm going to reconstitute the question, but I've noticed this as well. I've noticed that the rental market in Canada, in Toronto, in the GTA, has precipitously dropped in the past month. I don't know if the data is reflecting that yet, but I think we all feel it. To my mind, people, particularly in the new build space, had two outs, both of which have now closed. One is the assignment market that's gone largely illiquid, and then the market for rents has turned topsy-turvy, and there's very little demand at the present time. Where do you see that going? How do you see that playing out? Am I correct in that assumption? You would know better than I would, Jordan. I'd be interested if you want to correct that preposition in the first place. But if you agree with it, where does this go?
Well, there's bottomless demand for rental. It's just a question of price.
Right. Yes.
Right. That's all it is. So it's just a matter of, instead of getting 2,400 a month on your one in den or whatever, you're getting 2,200 a month. And you're even more cash flow negative. But I think what continues to surprise me is the amount of people who are willing to absorb the negative cash flow. Like, obviously, there's a lot of stories going around about interim occupancy, but that's a short-term problem, right? Because occupancy fees, depending on the developer and depending on the site, obviously it varies massively. But I've seen buildings close as quick as 42 days from ground floor occupancy. So it's like, it really just depends how long your building's in occupancy, how long that bleed continues. But yeah, generally speaking, like you can see it, right? You can see the inventory on MLS resale declining as inventory on MLS rental inclines. It's just a function of terminated resales repositioning as leases. And that's probably, going to continue from a seasonality perspective for all of December and probably parts of January.
That's an interesting way to look at it. You're right. It's not a rental collapse of the market. It's just a willingness to absorb greater pain by Ontario's landlords. That's all it is. And it's just, I guess what it is it's just a market balancing force that is coming to effect. So people are going to have to reevaluate their expectations, and price discovery is taking place. That's really, I guess, all it is.
Yeah, I think you're seeing, like, it does introduce a little bit of a irrationality as a consumer. Like, if we're in a position where people are literally, like, their goal is just pure loss protection, then they have a little bit more flexibility. Like, if they've already failed to sell at a profit, like Jordan's describing, and they're a termination that's entering the rental market, then they're in a loss mitigation. They've chosen to lose money slowly rather than lose money quickly. And so they're not as, like, that's a more agile price discovery mechanism, because they've already lost the money. And so it's just a function of how much more money they can lose. And the sooner that they rent, the sooner that they get cash flow in, the quicker that they are stopping the bleeding, per se. If you go, I can share this chart here, but I mean, if you look at just the best site I've found, at least from a rents perspective, is Door Insight. And if you look at their charts, you can see, this is just Toronto, but rents have fallen basically since August. Now, to be fair, rents typically fall since August. So I think it's probably too early to say. Like, you typically see rents kind of bottom in November, December, and then they rise into January, which you can see it happen in Q1 of this year. And so I think it's probably too early to call. Like, we are definitely seeing disinflation in rents. That huge surge of rent growth that we saw, it obviously is over. Whether or not we see further growth in rent in the next year, I mean, it would be fascinating to me to see, like, if you look at population growth, the numbers just came out yesterday: 430,000 people in the last quarter. Record population growth, like, since we added Newfoundland as a province, I believe, in like the 50s. That was like the last time we saw the Canadian population grow so quickly. But if you look at if you compartmentalize them, and I'll pull up the chart maybe for next time I'm speaking, but immigration, permanent residence status, is tapped out. Like people know that line is flat now, but non-permanent residence is increasing substantially. And now, if you'll recall, the federal government banned non-permanent residents from purchasing homes in Canada. And so when people say, oh, house prices are going to skyrocket because of all this inflation growth, it's like, no, that's probably not the case, because the big growth is coming from people who legally cannot buy houses. And beyond that, statistically, we know that even PR, people who are coming here with permanent residency, rent for about 3 years statistically before they take possession of a house, and that number is extending because of costs. And so you've got this massive increase in demand, but that demand is all being put into the rental side. And so if we see rents coming down against that massive increase in population, to me, like, that's a huge thing to be scared of. If you're seeing rent deflation against a massive increase in excess demand, it means that your economy is household consolidating faster than population is growing. And so
Right.
the people who like that would be probably the scariest trend that we could possibly see in Canada. So if watch rents for sure in Q1 of next year. I would suspect they're going to go up in January, but I would watch them for very closely.
Interesting. Jordan, I'm going to ask you an unfair question. Unfair because I don't know if you have the answer, but if anyone does, it would be you. Ansar asks, what percentage of condo assignments in the past 6 months did so at a profit? And then after that, I'm going to turn to both of you, and we're going to have an interest rate projection discussion as to 2024.
Yeah, this is obviously a really hard question to answer. I would say probably 50-50 after accounting for fees. You got to remember, a lot of people assigning today are still assigning 2017 contracts. Like, prices were a lot lower in 2017, right? The further we move into the future without any appreciation in the condo market, the more that skews to losses. I mean, I'm already seeing people take massive baths, but it really depends on the product and when they bought. So 50-50 today.
And what year pricing are we at the present time? In other words, great, it went up, and then it fell somewhat. Where does a break even take place? Is it 2019, 2018? Where are we presently?
It really does depend on where they bought, right? Because a pre-construction purchased in Hamilton in 2019 versus a pre-construction, like Hamilton condo resale values ran 2020 through 2023. So there's more appreciation on that than there is on a downtown Toronto 2019 purchase. So it depends, but I would say generally around 2019 is when that turn happens.
Okay, yeah, the nuance is obviously very important. All right, so let's turn our attention to interest rates and projections. Obviously, no one holds you to these, but we will be looking back on this for the 2025, and we'll be calling you out if you get it wrong. So, just keep that in mind. Where do you guys see interest rates going? How do you see that playing into the market? How do you see that playing into the products that are available to Canadians? Either of you can start.
I mean, I think it's obvious that rates are eventually going to come down. I think that a lot of people overestimate the magnitude at which they're going to come down. And I think it doesn't really matter whether or not they come down, because Canadians are addicted to debt, and the rate isn't really the problem. It's the amount of debt that's the problem. We've re-hit our all-time high of household indebtedness in Canada. So 118% debt to disposable income ratio. And so a deleveraging needs to take place, and cheaper rates doesn't really make that easier. Actually, if anything, cheaper rates makes it harder for people to deleverage because it's compelling for them to stay in debt. In our economy, quite literally will not grow until that deleveraging takes place. Like, we're right now, and these are the problems that are actually facing Canadians. So real GDP per capita is falling off of a cliff. Our economy quite literally hasn't grown on a real GDP basis since 2018. So we are worse off today economically after everything that has changed than you were in 2018. And that's only going to continue because the number of people in the economy is going up. And so the pie is growing, but it's growing at a smaller rate than the number of people. And so that's cut up between more people. So the quality of life will begin to suffer. And so Canadians are just going to have, at a certain point, are going to have to capitulate and realize that the quality of life that we had for the past 20, 30 years is over. And whether or not that means that, I think the deleveraging starts with, and you're seeing it already, auto loans going delinquent, credit cards going delinquent. We're seeing an increase in consumer spending right now, which you'd have to see whether or not it's adjusted for inflation and population growth, but it's up like 7% compared to Christmas of last year. Population grew like 3% in that period of time, and prices grew 3% in that period of time. So maybe it's only up 1%. But it's also all fueled by debt. That most recent Equifax thing just basically showed that Canadians are just piling on debt. That's how we're paying for things right now. And so my thought is the central bank, the Bank of Canada, will have to follow the Fed. And it seems like the Fed is going to try and engineer a soft landing with maybe 25 basis points per quarter starting in Q2 kind of thing. I think things will break before then and we'll see emergency cuts, to be honest with you. And so I think that the big question that Canadians should be asking themselves when it comes to rates is, if I think rates are going to come down 100 bips or 150 bips, what takes place before that, and what conditions need to be met for cuts of that magnitude to take place? The answer is probably a pretty bad recession. And so it's just to be careful what you wish for thing, right? I mean, if we're coming 25 basis points per quarter in Q2, Q3, Q4, that's a best outcome, like really is, right? If you're seeing 50 and 50 and 53 announcements in a row, things are bad. And Tiff already said like it's going to be ugly in Q1 of next year. So I think their current objective is probably like 75 to 100 bips of cuts towards the end of next year, slowly. I think that they'll be forced to change that objective, but as it stands right now, with everything the way that it looks, I would say that would be like that would be the rate path. The only other thing I would say is that I think that we might have to diverge from the Fed a little bit because, again, the household indebtedness is far worse in Canada and rates are far more painful here. And so I would expect that eventually we'll start importing inflation a little bit. I think we'll see a resurrection of inflationary forces. There's a lot of stuff going on in the shipping world right now. So maybe just read up on a lot of that stuff and formulate your own thesis. But if I could see the central bank in Canada being comfortable running a little bit of a hotter inflation, that 3 to 4% range for like 2 to 3 years, because it's the only way, other than letting that household indebtedness actually burn down, economic Darwinism to take place and people to sell off, deleverage, take losses, etc. It's the only way to get away that debt. And so to inflate away that debt. And I could see that potentially being a policy objective of the central banks, silently, obviously, right? I think I could see them being more comfortable with inflation for I guess a couple years, and the US far outperforming us on a currency basis. I think that's all I have there.
Got it. Thank you. Sorry about that, guys. I flipped a setting and I apologize for that.
I like
all right, Jordan, over to you.
Yeah, I mean, Dan's better at this stuff. My rate predictions have been absolutely horrific. So I think I generally agree with Dan. A lot of people want to talk about, hey, look, people are renewing from the 2s and the low 3s. So 25, 50 basis points doesn't actually do anything to the market. I would fundamentally, I mean, it's slightly better to be renewing a little bit lower than higher, obviously. But you're still renewing, so your monthly payments are increasing. It's crunching your family's budget. But also, the one thing that's really hard to control for that I've learned in pre-construction is the Canadian home investor. The sentiment of them is really hard to control for. So I know in just the last 2 weeks, the amount of emails, I've been getting more than one email every single day, people looking to pick up distressed assignment sales. They're trying to front run the cuts already, right? So I guess my point in that is, I don't think the pre-construction market will come back in any meaningful way next year, just simply because the price premium above resale is too high. And for slightly more you know, again, return on pain in the ass, you can buy a much better deal on the resale market. And for, again, a slightly higher return on pain in the ass, you can buy an even better deal than on the resale market. You can do it on the assignment market. You just have to do some digging and some deal structuring. And so I think the reality is the pre-construction market's going to be incredibly slow next year. I would be shocked if a couple of cuts brings it back to life. But I do think I do think people will be surprised by what a cut or two will do for the Canadian home investor in terms of sentiment alone.
Sentiment I agree with. I'm just going to pump in my own 2 cents here for a minute. You know, whether this goes down 75 bips or anything else, the truth is I think that people have been living through higher interest rates by holding their breath. And that is to say, it's been a bleed. And the fact that, you know, you start to cauterize the bleed doesn't mean that the blood that has left your body has not already left, and that additional blood is still flowing. Lower interest rates may stem some of the velocity of what we're going to see, but I think that 2024 is going to be the year where a lot of Canadians face insolvency trustees and have a lot of hardship just because they've been holding on by a thread, and interest rates are not going to go down to anywhere near to where they will actually be able to recover or even survive. So I'm just throwing that out there because that's what I'm seeing on a daily basis in my office. This is not a fair question for Jordan, but I'm going to ask it to both of you. I have a feeling Dan's going to jump in first. Arthur asks, can we get an overview on the land situation and cottage situation projected into 2024? Where are we on cottages? Discretionary incomes.
I mean, you can already see it taking place. I think I would say probably on a price decline basis, most of the cottages, most of the damage has been done in the cottage market. Like I think we've seen like 30 to 40% blow offs and a lot of that stuff. And it was the first to go. Like it's just like, you know, like I have Kijiji alerts on, like always looking for like an ATV or like a trailer or whatever, right? And there's just blowing up like over the end of the summer this year. You know, you could get like jet skis are down 50%, yeah, ATVs are down 50%. So cottages is the same thing. They're just the property version of that, right? And so these are the thing with cottages, they're a liquidity trap, and this is where it's really an important thing to look at, and that's the phase I think we're going to get into trouble with. Cottages in 2020 went from a 90-day sales cycle to a 9-day sales cycle. And so a lot of people buying them, we're seeing them fly off the shelves and saying, oh, like this is liquid. And not a lot of people, this happens in your subconscious, right? Nobody's like, oh yeah, worst case, if I have to sell this, I can, because it'll sell in 10 days. But that happens in your subconscious. So you just feel safe buying it because you feel like it's a liquid product. Cottages are not a liquid product at all, right? Land is the same thing. And it was liquid during COVID because people couldn't travel and everybody was making impulsive purchases and everybody had money and the economy weathered this like major economic storm. And so everyone was feeling invincible. Now that's gone. And now we're not back to 90 days, but we're back to like 50, 60 days average days on market for a seasonal property. And the challenge is cottages cost money, right? It's a lot of maintenance, it's a lot of upkeep, it's maybe a mortgage to serve. And so you're spending money on something that is just sitting there, not selling and maybe going down in value. And this is where I think when you look at assets that have options, whether or not you can even lose money fast or slow, they're the ones that are harder to lose money slow on. And so people will be forced to either liquidate or lose them. And you're seeing a bit of an assault on the Airbnb. I mean, Airbnb bookings were down like 50% for this summer compared to last. But then I think you're seeing a little bit of an assault on the business model of Airbnb from municipal, federal, and provincial governments. And so that's a challenging one. I think that the pain is like on a price basis, pain is already behind us. Most of the drops have already taken place. I think that the actual pain for individual owners is just beginning because they can't sell and it's costing them money.
Very good. All right. Jordan, do you have anything? I suspect that this isn't your bailiwick, but if you want to contribute anything on this?
No, I just mirror that exact same sentiment. I mean, look, everybody sells everything before the primary. You see it it's the exact same as the investment condo, right? Just replace cottage with the investment condo. Why are condos sitting at 6 months of inventory while freehold is at 3? Well, it's very simple. Freehold is more owned by end users, and condos are much more owned by investors. The recent report, 0 to 5 year old condos, 60% by investors. So, of course, that's the first thing you liquidate. I think it's no different with cottages.
Jordan, can we just hark on something that Dan talked about before with regards to Airbnb? I think Airbnb is going to play an important role in the condo market, particularly if Toronto goes whole hog like New York. Can you give us your understandings of where things may go in that, and how that, if there is some form of more stringent ban, particularly given the CRA changes that no longer allow for deductibility where such plans are in place, how will that affect the condo market? What will happen?
It's going to cripple specific buildings, right? By and large, most buildings do not allow Airbnb. So it'll cripple the buildings that do, because Airbnb investors flood to those buildings, right? So you have essentially condo buildings that are basically Airbnb buildings, the whole thing. So it'll cripple the resale value of those specific buildings. But generally speaking, I mean, most condos do not allow Airbnb, especially most of the new ones.
Very good. I'm going to open up to questions because we have 15 minutes left, and I think people want to. Guys, I'm going to ask you, because we have 150 people in on this channel. Can I ask people to just please raise your hands by Zoom, and I'll just call on you one by one. Anyone who wishes to, please just raise your hand, and I'll call on you, and then you can unmute yourself and you can go forward. Anyone? If not, then I'll start reading some questions, but if any of you would like, just raise your hands. Give you the option of learning how to do that on Zoom. I'm not sure how. I know that it's whatever. There's some way. All right. In the meantime, I'm going to read one of these questions just while people are learning how to raise their hands on Zoom. Okay, so let's say, where do our you click on the reactions and then you click on your raise hands. Thank you, Raj. Where do our experts see the fixed rates in the near 3 to 6 months for 3-year fixed uninsured mortgages? Would you recommend a 2 or 3 fixed rate now versus variable rates? I mean, that's more of a Ron question, but as all we have is his untalking head behind me and David, I'll turn it over. Jordan, why don't you take a crack at this one?
I'll leave that with Dan. I have no idea, man.
Yeah, all right, fair enough.
Lower.
Yeah, I try not to touch too much on like actual rate advice either. It's kind of out of the scope of what I'm supposed to be talking about. But if it was me, I mean, I earlier this year closed on a property with a 5-year fixed, and it was just because it was just a pricing decision from my perspective. 5-year fixed was cheaper than the 2 and 3, and I didn't see the rate path on variable heading down. I mean, I think that the rate path, I've discussed what I think it'll be on the variable side. I think you could end up seeing more of it, more downside to the variable. So like more decrease on the variable on the Bank of Canada rate if we're in a recession. And so given that 2 and 3s are priced pretty high, like I think the banks realize that a lot of people were taking them. They're definitely priced significantly higher than the 5s. Your variable might end up being the cheaper option on a versus a 2 or 3. If your goal is to get a new rate in 2 or 3, like if you're hoping to get a new rate in 2 or 3 years, at a cheaper, your perspective, I mean, I guess if you're asking me this question, your perspective is that rates will be meaningfully different in 2 or 3 years, which I don't think they will be. Like, I think we'll probably be pretty close to the same rate environment. And so that's why I'm comfortable in the 5. To me, the 5 and the variable would be very similar in that respect.
Dan, can I ask you a question? Do you find
Yeah.
any problem in liquidity in the private markets at the present time? I'm not experiencing that yet. I keep a very close tab on whether or not there's a problem. There's a problem with appraisals. There's a problem with actually, privates actually extending on the LTV. But
Yeah.
I don't find that there's any lack of liquidity as I have in previous recessions. Do you see any change there?
There was, like, I think that at the beginning, all your HELOC lenders left pretty quickly when the spread decreased, but a lot of that's been priced in. Like, you're seeing a lot of privates just pricing now at like your 13, 14 plus 1, 2 rather than 10 plus 1 to 2. Because they were borrowing at a HELOC that was 3.5, that's now 7.
Right.
So I think a little bit of it dried up pretty quickly. And the more risky capital dried up pretty quickly. But once prices stop, like I think when you're on the downstroke of the price curve, and now that like you're kind of in that more flat looking part of the price curve, private capital does seem to be returning to the market a little bit more for solving problems, and it's just like it's different capital, right? It's more of a rescue, it's more problem solving. It's not like, yeah, go flip a house at, I'll give you 90% LTV because it'll be worth 100K more next month, like
Right.
that stuff's gone. Yeah.
Ensar has decided to lob you a softball, Dan. He said, what happens if there's negative job growth? What happens to over the next 2 quarters? What happens to the market?
Um, I will quote everyone's favorite pundit, Tiff Macklem, to say that the biggest headwind for people not paying their mortgage is not having a job. And so we're finally at that phase, I would say, right? Like, when during that, I think that was in 2020 when they were asking him if, I think it was Pierre was asking him if rates, how many Canadians could weather a 3x increase in rates. Which was crazy in hindsight, right? And he said, that he didn't think that rates were an issue and that job losses will be an issue. I mean, we're seeing a huge increase in labor force participation rate. That like jobs are still growing, by the way. Unemployment is rising, but we're seeing more hiring take place. The labor force is literally growing so quickly that unemployment is outpacing the number of hires. So like the economy is kind of growing. It's just not growing on a real basis and it's not growing on a per capita basis, right? So all of the growth is just coming from the fact that we're expanding the pie and then we're cutting it up more times. So anyway, my thought is it's pretty obvious, I would say, that people who don't have jobs have a harder time paying their mortgages. So I would say it's definitely a headwind. And it's worth noting that the Canadian government in their fall economic review, who is like usually very, very wrong with this stuff, they forecasted a 6.5% unemployment in the coming year. And like 6.5 unemployment is like that's rate cut territory. And I think that's going to get blown out. I think we'll see in the sevens for sure. Maybe even higher. So yeah, I mean I think that kind of tells the whole story there.
Awesome. That was a great answer. All right. Well, let me turn to the experts. Guys, what do you want to tell the crowd about what you think is something that they need to be on guard for? Actually, before I ask that final wrap-up question, let me have Van just put up his hand. Van, go ahead, unmute yourself and ask your question.
Thank you. So related to the last question, with the overarching story being not enough housing, what do we have a prediction on timing of the ultimate swing from a balance to a seller's market in the GTA? Considering those factors of interest rate drops to fight recession versus the effect the recession itself may have.
I at the risk of sounding too bearish, my answer is like 7 years from now, to be honest with you. Like, the 90s is like a really good example of like how this played out in the last time we saw a counter cycle in Canadian real estate. And we're following the price curve exactly. And we're following the immigration curve exactly. Like immigration is flatline. People don't actually want to move here on a permanent residency basis. Non-permanent residence is skyrocketing. And so when I talk about the quality of life for Canadians in decline, the most material way that that's going to show up is our house sizes are going to shrink and the number of people per household is going to increase. And so and you can like this is all wide open right now. You can see it. Policy is the federal government is literally going around bribing municipalities to upzone their residential neighborhoods to 4 units. So and last year I said within a decade, more than 50% of residential land in Canada will be upzoned for more than 2 units. And we're already heading in that direction. London just did it. Toronto just did 4 units. Vancouver just did 6 units. So, and then we're seeing a push towards multi-generational living. We're seeing, and not that there's anything wrong with this, by the way, but it's just like you can very visually see in other places in the world. Look at Europe as an example. In 200 years ago, Europe, everyone could immigrate to Europe because there was a land path to get there or through the smaller seas. and everyone who wanted to migrate there, if they had a more open immigration policy, they could grow their economy in that way, and they didn't need to grow their housing base because they were overhoused to begin with. Right now in Canada, the US, and Australia have the 3 largest house per square foot per capita in the world. That we're overhoused. You have baby boomers who all have 3 on average 3 excess bedrooms. And so what's going to happen? Well, all these McMansions are going to end up getting cut up into multiplexes slowly but surely. That's what's going to take place over the next little while. And the writing's on the wall. Like high rise construction is decreasing, and it's being replaced with purpose-built rental construction. The primary growth in housing starts in Canada is all from purpose-built rental construction. All of those developers who are experts are not just going to build houses to hold for themselves, because that's the only area in which the economics of it makes sense. And so if I were to look at this and I were to look at what happened, and this will go into sort of what I wanted to mention anyway. I think like you're going to see a big downturn, and on the tail end of that downturn, I want you to Google what a K-shaped recovery is. In a K-shaped recovery, you have a top line where one class of the economy outperforms a different class of the economy, and so the outcome of the quality of outcomes or success of outcomes is divided based on 2 different groups of people, and the difference in this is going to be asset holders and non-asset holders. So the Bank of Canada and the government, I think the government obviously cares more about they don't care about inflation, and they don't think that they're causing inflation, and so we're in an era of fiscal dominance. Government's going to keep spending. Bank of Canada can't outcut them. And so if we're in an inflationary period, inflation benefits real estate. Real estate is an inflation hedged asset. It's basically a cake that bakes all of these components that are inflationary into it. Lumber, labor, plumbing. You go to anyone who's tried to hire a contractor knows you've seen inflation over the last little bit. So you want to survive, and I'm not bullish. Like I actually don't believe in I think house prices will still continue to decline, but I think inflation is what brings them back. And so in an inflationary environment, if you want to be on the top line of that K-shaped recovery, you need to hold hard assets, and real estate is the easiest one for most people to hold. And the bottom line of that is people whose buying power and all of the money that they have possession of will be inflated away from them. And the people who are on the asset curve, their debt will be inflated away from them, and the asset value will be inflated in their favor. You can see it all. It's all there. Like you can, policy is showing you exactly what the next 10, 20 years of Canada are going to look like. And that's it, right? Everything's that it's just there, right? It's not hidden. It's not like everything I said is not proprietary information.
Amazing.
Thanks, Dan.
All right, Jordan, over to you. You want to leave us with some notes, some perils, some things we should be looking out for, and some optimism?
Yeah, I would just watch for appraisals on entire buildings, right? So when buildings come up to that's sort of the biggest risk to me, is appraisals falling short on an entire building. Now, we haven't seen it yet. We've seen small boutique buildings by third-rate developers in small pockets that had quick builds. We've seen that, but we haven't seen like a big building by a good developer in a good location fall short on appraisal. That's when things get really ugly for the condo market, in my view. Now, I will say I've seen appraisals come in on buildings that they shouldn't have, in theory, on units that they shouldn't have, in theory, which is sort of interesting to me. But that's when you sort of see maximum pain. Again, purely in my opinion. I just I'm not sure. I'm not sure it's going to happen this year or this coming year.
Fair enough. All right, guys. So we have time for one more question before we wrap up. Does anyone want to take a crack at the last one? You can just unmute yourself and ask your question. Hit it up. Last one. Who wants to do this? No? Going once? Going twice? All right. So guys, I want to thank Jordan and Dan. Guys, you can see why it is Jordan and Dan are perennial favorites. There really is something to being an expert in your field, honing your craft, and spending endless and countless time poring over the data so that you can derive conclusions that are insightful for those of us who are in the industry and continue to be insightful. month after month, year after year. Please follow them. Dan, Jordan, if you'd be so kind, please, as to give people your handles so that people might be able to follow you and know how to track you. I'd appreciate it for those of you who are just meeting you for the first time. And I would tell you guys, there are a few people who I follow who I just trust implicitly. These two gentlemen are amongst them. I can't thank you enough for coming in today and sharing the benefit of your knowledge and your expertise, guys. Jordan, why don't we start with you? Just tell us your handles, tell us how to reach you, and then Dan, please do the same.
Yeah, it's just Instagram, my name, and YouTube, my name.
Easy peasy. Dan, go for you.
Yeah, I put mine in the chat, but Instagram is Daniel Foch and Twitter is Daniel_Foch. The best places to find me.
Awesome. All right.
Thanks, everyone.
Thank you all.
Really
This will be.
Happy holidays. Happy New Year.
Thank you, man. Happy holidays to everyone. I will be posting this on the forums, and I thank everyone for your attendance. We hit about 150 people here today at our max, so that was awesome. Thanks, guys.
Thanks, Mark.
Thanks, Mark.